My first ever development was a $34 million, 192 unit apartment complex that I financed with $0 of my own money. Then 12 years later, I went on to develop a $92 million apartment development, and once again, with very little of my own money, all while building quality, affordable housing, building millions of dollars in equity, and in total, over $500 million of development value along the way. I'll be showing you exactly how I was able to do this with $0 upfront and how you can too. I'm Evan Holiday. I've developed over 2,300 units of affordable housing, and I make videos every week showing you how to do the same. So what is a capital stack? A capital stack is basically just a fancy way of saying all the funding that it takes to make an entire development happen, from designs to construction to lease up. Your capital stack is typically built in layers like a cake. Cakes are all made differently, but they're always consistent ingredients like sugar or flour. Similarly, most capital stacks include a loan because most people don't have $40 million just sitting in their checking account. But here's how affordable housing capital stacks really get interesting. Instead of two layers like a normal market rate deal, where you have like a 60 to 70% loan and then the rest would come from equity, our affordable deals can have 4, 5, 6, or sometimes even more than that in terms of funding sources. Why is that? Because we are serving families that cannot afford the market rate rents, so we're offering much lower than market rents. So we need to get creative in the way that we finance our deals so that the lower rents still make financial sense to the deal. To make affordable housing work, the government has to step in and help pay for part of the project, or what's called like a public-private partnership, or PPP. And that is where our capital stack gets a whole lot more complex, but also a whole lot more powerful in that you are leveraging public dollars for public good. But when you stack those 4, 5, or 6 different funding sources correctly on your first deal, then you and your partners could be able to not only create affordable housing, but own 100% of the asset with none of your money upfront. All right, layer number 1. Tax credit equity. This is the foundation. This is about 40% of your capital stack. For my first deal, the deal cost about $34 million to build. So I needed to have $34 million in my capital stack in order to afford 200 units of development. Of that, $14 million came from our tax credit equity, or about 40% of our capital stack. These credits are extremely powerful. They were created by the federal government in 1986 when they realized there wasn't enough affordable housing being built, and the previous model of public housing absolutely was not working. So they wanted to get private developers like you and me involved in solving this problem. Here's how it works. The federal government allocates these credits to each state, and their state agency then allocates it to specific developments. The state will decide which projects they like the most based on certain criteria, and then award the credits to those developments. Here's where it gets interesting. You then sell the credits that you get for your development to investors, which are typically banks, who then give you cash in return to help pay for the development. Why do banks want these credits? Well, they get a dollar for dollar tax write-off for each tax credit they get. So if they get $10 million in tax credits, they get to write off $10 million on their taxes. It also helps that through the Community Reinvestment Act, banks are actually required to buy these credits. So you have, in a way, a built-in demand for this tax credit equity. From my experience on our 200 unit deals, we'll get about $30 million of tax credit equity. One of the benefits of this partnership with your tax credit equity investor is that they don't want the cash flow and they don't want the profits from this development, which sounds a little counterintuitive, but that is because they are getting all the tax benefits through the tax credits, the losses, and the depreciation from this development. So you get to keep all the cash flow while they get all the tax write-offs. Now, I'm just scratching the surface here about tax credits. If you want to dive deeper, I've made a whole video explaining how the low-income housing tax credit works, and another one explaining the difference between a 4% and a 9%. I'll link those videos below if you want to dive deeper into this topic. Layer number 2 is your debt financing. This is about 50% of your capital stack. Now, this isn't your typical bank loan, and you actually have multiple different options here depending on how you structure your deal. Option number 1 is tax-exempt bonds. You must use tax-exempt bonds with your loan when you finance with 4% tax credits. Think of tax-exempt bonds like this. You're going to Wells Fargo, but instead of getting a conventional loan, you are getting a tax-advantaged loan, meaning that your lender will get tax exemption on the interest income that they make off of your loan. And in turn, the lender can offer your deal better terms and lower interest rates. And this is specifically for affordable housing. The interest rates on tax-exempt loans can be sometimes 0.5% or even up to 1 full percent lower than market rate loan. So if a typical loan is at 7%, your tax-exempt loan could be 6 to 6.5%. That difference can add up to significant savings on interest over the life of a loan. Option number 2 is conventional construction and permanent loans. You can also use regular bank loans, especially if you're doing a 9% tax credit deal, or if you're mixing different financing sources. These work like most of your other conventional commercial real estate loans, but you will typically still see lower interest rates and better terms on affordable deals as compared to market rate loans. Now, there's one more option that's worth mentioning, even though it comes with a lot of headaches. It's called a HUD loan, or more specifically, a HUD 221D4 loan. These are loans that are set up for new construction development and are both a construction and a permanent loan combined. I've done 2 HUD loans. One was for about $20 million, the other one was for about $21 million. And I tell people that I got all my gray hair from those 2 HUD loans because it was a lot of work. But here's why some developers still use them: because you can get a 40-year, yes, I said 40-year loan term and amortization. And if you're asking, amortization just means how long your loan payments are stretched out. So a 40-year amortization spreads out your principal and interest payments over 4 decades. That lowers your monthly payment and can make deals pencil out more easily. And the term is how long you can keep that loan. In the private market for affordable housing developments, the longest you can typically get is about 15 to 17 years for your term. And on market rate deals, it's even less. It's like 5 to 10 years. But with HUD, you can close on a loan today and keep the same loan and the same interest rate for the next 40 years. Plus, HUD's interest rates are usually cheaper. If normal rates are about 6.5%, HUD could be at about 6%. And it's non-recourse during construction. For those who don't know, that is huge. Pretty much all other loans during construction are all recourse. Non-recourse means that if something goes wrong with the development, the lender can only take back the development, not your personal assets, like your house, your car, or even your favorite family heirloom toaster that's been in the family for 80 years. The downside of HUD loans, though, is that it can take up to 10 to 12 months to close a loan, as compared to a normal loan can do like 2 to 3 or 4 months tops. And in general, it's just a really long and grueling process that makes you literally want to pull your hair out. But it can be worth it for the great terms that they offer. Now we're getting to layer number 3, and this is where most deals live or die. The final 10% is called gap funding, and it is exactly what it sounds like. It fills the gap between your loan, your tax credits, and your project's total overall cost. Without this piece, your deal does not work, period. If your total project cost is $20 million and your other sources only cover $18 million, then your gap is that $2 million that's left. Let me break down the 4 main types of gap funding that you could use. The first is tax abatements or pilots. Pilot stands for payment in lieu of taxes. This is where the city agrees to reduce or eliminate your property taxes for a period of time, usually 10 to 20 years, in return for providing the city with affordable housing. Here's how the math works. Let's say your normal real estate taxes would be about $1,000 per unit per year. On a 200-unit community, that's $200,000 per year in taxes. If you get a 100% tax abatement for 10 years, then you're saving $2 million over that period. But here's the key: that tax savings helps increase your net operating income, or NOI. And then by increasing your NOI, you can then borrow more money in your loan, so you get more funding to the project through the increase in NOI. So basically, if you get these tax savings, you can then borrow more money to pay for the development. The next way to secure funding is from grants. Grants are basically gifts to the project with no expectation of being paid back in return for providing the affordable housing. There are several types. Home funds, and these come from the federal government and are allocated to local or state agencies who then figure out which projects to allocate them to. CDBG funds, or community development block grants, are very similar to the home funds, but these are geared towards public infrastructure projects like public sidewalks, infrastructure, or even some parts of affordable housing. And National Housing Trust Fund dollars, this is a federal grant that goes to the state housing agency that then funds the lowest income housing unit. Another way to get gap funding is through soft loans. These are different than grants because they are expected to be paid back, but usually out of cash flow in the far future of the development. Think like 5, 10, or even 15 years out. In simple terms, these are low or no interest loans that do not count up against what a bank thinks you can safely borrow on the development. Many of these same agencies that offer grants will also offer the soft loans. Think this is coming from your local housing authority, the economic development office, or your state housing agency. And cities are now seeing that the federal programs for housing just aren't enough to cut it to help solve the housing crisis. So cities are now setting up their own local housing funds with set aside dollars from local taxes to help fund more affordable housing and create their own either grant or loan programs. I will never forget my first grant application. It was right before Thanksgiving, and I figured I'd have plenty of time to get it done before Thanksgiving Well, I was dead wrong. So I convinced my family on Thanksgiving Day to help me, like in an assembly line, assemble this application. And I basically got it to FedEx to overnight to the state housing agency 5 minutes before the FedEx closed. But we got it done. We got 2 applications in, and we got 2 awards for each for $1.5 million of home funding. The lesson here, start your applications early and don't underestimate the amount of paperwork. The fourth way to get gap funding is through project-based vouchers. This one is a bit more complex, so I won't go into it completely, but basically you can get your project-based vouchers from your local housing authority. The voucher helps a lower income renter help cover any of the rent that they cannot afford to pay, while also providing the project with guaranteed income for that unit, which allows you to borrow more on your loan. Comment if you want me to make a video explaining how this works. Layer number 4, your deferred developer fee. This is essentially you lending money to your own deal. When a developer builds, the state agency allows them to charge a developer fee at certain milestones of completing the project. Think of it like this. Instead of getting paid all of your developer fee at those certain milestones, you're basically agreeing to defer or put back in part of your fee into the deal, and you'll get paid that fee later on out of cash flow from the deal in order to make the deal work today. Your developer fee can be anywhere from 5 to 15% of a project, just depending on the state agency rules. So on a $50 million project, this could be somewhere around like $5 to $7.5 million. But you don't get all that upfront. You're looking at some at closing or when you start construction, that could be like 20 or 25% of your paid amount of fee. Some when construction finishes, and some when the project is fully leased up, and then you get the majority of your paid fee when the property stabilizes, or basically when the property is 100% occupied and fully operating. This is a common way in which developers make deals pencil, especially when every single dollar counts. So there you have it, the 4 layers of the capital stack. You have your 40% tax credit equity, where you sell tax credit benefits to investors for cash. And then you have your 50% debt, which could be government-backed or traditional loans. You have your 10% gap funding, which could be grants, soft funds, or tax abatements. And then you have your deferred developer fee to help close whatever gap is remaining. And that's where you help finance your own deal. That's it. That is how you can fund affordable housing with zero of your own money. Most developers won't touch this because it looks complicated. So in a way, this is like a blue ocean strategy. But once you understand this strategy, you can build communities with impact. If you're ready to go from watching developers build these projects to leading your own, then that's exactly why we built Affordable Development Mastery. We coach dozens of new developers just like you to do their first affordable housing development, taking them step by step from finding the land to closing on financing. There's a link in the description below. And if this video helped you understand capital stacks, hit like, subscribe, and comment below with any questions. I'm going to answer every single one of them.